Okay, Helen has a 0.75 chance. Usually I would label these, but Helen has a 0.75 chance of getting sick, in which case that would be her income, 125,000 minus her premium, and this is not a fair premium anymore. At the full premium price, okay, of 48,000. Yes. By the way, Patricia, feel free to make any comments or anything like that. Let me see. Okay, so then I do not have to find that number again. We've just computed it. Okay, and this is important for the test. Don't just, start, like I'm pointing out minor details like that just adds up to 1 times the square root of the difference. And here, I'm not going to compute that again. I take advantage of the fact that we're using the same numbers. So here, when the professor gives both agents the same income, she's making our computations a lot easier to follow. And then I just have to know what to compare it with, like someone says. So I would compare it to Helen's expected utility without health insurance. And this is also why I tell students it's important to label, because sometimes I see some answers and there are just numbers everywhere, and then they might just have 10 is greater than 2, and then I don't know what those numbers mean. So when you label, that's a lot nicer. So then we'd have 216.11 to compare it to. And then, of course, I mean, we have to step back, okay, and think logically. If Helen was willing to buy health insurance at a fair premium price of $72,000, then she would also have had to be willing to pay $48,000. So even without having run the computations, I know that she was going to make the purchase. But that it still may not answer the question completely, because some professors want to see the full work. But then I see that my answer makes sense. If someone is willing to buy a laptop at $72,000 or $78,000, let's see, $72,000, of course they're also going to be willing to buy it at $48,000, given that probabilities of getting a heart attack is unchanged, and given that income is unchanged. So then that answer would make sense. Okay? So Helen will make the purchase. Does everyone follow? No, I erased it because I copy and paste. So then I input the correct answers. Yes. And then I say that the utility is greater, so Helen should make the purchase. Do you need to put this? Yes, you do. Or you need to spell it out in words, okay? But the professor has to get the idea across that we realize that one is greater than the other. And that's why we are telling the consumer, we're saying that the consumer is better off with that action versus the other. Yes, that's important. I mean, that's the explanation behind it. And when you say explain it, that's really all they mean, find utilities. Okay, because once you show that, pretty much there's not much to be said. It's then clear that the consumer, given their preferences from their utility function, would be better off. Okay, and then we have the last exercise on that worksheet, letter F. It says to calculate the loading fee. Yeah, I touched upon it last time. Let me see if I can open that. Give me 1 second. Yeah, no problem. We have time. It's just I also try and remember myself. Let me see if I have it here. That's correct. I think that question is broad, and keep in mind I don't go to class, and every professor is also different. So I'm having a hard time interpreting that question also. But give me one sec. I'll try my best. Give me one sec. Because I do find that question a bit broad. I'm just trying to open the formula sheet. Because last time I believe I sent you a formula sheet, but I didn't send you both. I think I had two of them. I have one called formula sheet and the other formula sheet review. All right, okay, so now you should be able to see the formula sheet review from last time, and we went over a loading fee, okay? No, it's fine. Let me see. A loading fee from the formula sheet, basically what I got from it and how I would understand it is that it's equal to the total premium, okay? So total premium is whatever the insurance company wants to charge, because we went over a fair premium, but an insurance company doesn't want to charge any fair premium, I don't think. They would want to charge just the total premium that we'll assume it's above the fair premium. So in that regard, I call that almost like an overcharge or a markup, right? It's almost like the extra revenue I want to receive from insuring that individual, which would equal the total premium minus the fair premium. And the fair premium, we know it's equal to the expected payout. Okay, so I'll say it again. Loading fee is equal to the total minus expected payout. Okay. Now, why would a company want to have a loading fee? Well, the loading fee is basically all of these right there. It's the administrative expenses plus the taxes plus the profits. So loading fee is what I call an overcharge of an amount equal to overhead costs plus the taxes plus the profits. Did that make sense? Let's see how she has it in the formula sheet. She has it as premiums minus expected payout. Okay, that's how she has it there. And basically, she also breaks it down into these, which is basically overhead, right? So let's say I charge $30 above, oh, it's hard to read. Is that better? Basically, it's coming from the formula sheet. Okay, so I zoom in a little bit. Okay, so basically the loading fee is equal to the premium. And to me, I didn't like the word premium. You know, it's like, it's too broad. So I called it a total premium minus the expected payout. You see, because I like to use words that I can remember. I cannot remember all that. Okay, but I can remember expected payout, and I also know how to find expected payout. So then the loading fee is equal to the premium minus the fair premium, total minus expected payout, and then I know that it's an overcharge equal to everything other than the expected payout, which would equal the administrative expenses plus taxes plus profits. So I need to pay my office rent, I need to pay my labor secretary, I need to pay my business taxes, and then whatever's left over would be my profits. Okay, so let's go back to the problem. If you came in late and stuff, I'm just referring to handout 1 by Dr. Gumus. So I don't know, Patricia, if you're in Dr. Gumus's class. If not, you know, feel free to jump in and also suggest other questions. I'm almost done with these handout though. Let me see. Calculate the loading fee for the insurance company. Based on your answer, do you think this situation is sustainable for the health insurance company? Okay, let's look at that. Okay, so let's go back to our answers. Okay. Nicola, I believe you told me you had the answer key. So what I'll try and do is I'll try and make a suggestion for an answer, and let me know if I get it right. But I want to try it out myself, so I could explain the logic behind it. Okay, even if I'm not correct. Okay, so basically we have part F, and basically they're asking if to calculate the loading fee. Okay, so what I'm guessing is that they're referring to part E. So let's look at that. We know that, I mean, by the way, whenever I need to use a formula, I always have to write out the formula, even if it's as simple as this one with only 3 variables there. And if it helps, put it in words that make sense to you, not just however it makes sense to the formula sheet. So we have loading fee equals total premium minus expected payout. Okay, so we have 2 customers. So let's calculate the loading fee for Laura. Okay, for Laura, I believe we were going to pay her we were going to charge her $48,000, but she did not take the health insurance. So I would say there's no loading fee. Correct, she's out. Okay, I mean, that's interesting, right? Because I could say I sell jackets and I'm going to make $100 for each jacket I sell. Well, that's not true unless I have someone buying the jackets. So in this case, Laura is not buying the insurance premium, so that would not work. Okay, so then let's move on to someone else. Let's find the loading fee for Helen. Okay, and we said that we wanted to charge Helen $48,000 at the pool price, correct? At the pool premium, because I'm referring to part E. Okay. By the way, I'm just trying to think of it as if it were in the test. And then her expected payout, however, I believe was $72,000. Okay. So then, basically, what I'm saying is, on average, I'm going to pay her $72,000, and on average, she's paying me $48,000. So on average, I'm incurring a loss of $24,000. Okay. Now, I mean, is a business that's making losses sustainable? That's correct. Notice that I did not say it's 48,000 minus 0.75 times 96K, because we had already found the expected payout. You see, the expected payout was equal to the fair premium. So, for instance, in the test, that's what I mean, that you may want to, so I appreciate that you have it because it explains the concept and the formula. But I mean, we had already found that one, and I would say that the expected payout, again, is not just equal to this, because in the case that there were a second outcome, like she goes to the hospital just to get a checkup and say it was a false alarm or something like that, and then they might charge her $100. It may not have to be an outcome of 0. So that's why I don't like that simpler formula. So I want to carry out all of these, and then we find 72,000. Again, I'm just giving my opinion in order to, I guess, explain it in detail. So in that case, you know, it would be repetitive, and you may lose time in the test. But if it helps you, like let's say I'm unsure and I want to double check my answer, that's a good approach to go about it. And then, of course, a business that's making a loss is not sustainable. Well, so what I did is the total premium that we would charge Helen wasn't $48,000. That's the pool premium, okay? But maybe we didn't expect that Laura would drop out. But Laura, being a smart consumer, she drops out. Her expected utility is lower. So then Helen stays because she's also a smart consumer and she knows she's getting a good deal based on her risk. But then as a business, I incur a loss. This is adverse selection in a way, because then the more healthy individuals dropped out because the price was too high for them. The 72,000 is the same as you have. Okay, let me repeat it. The expected payout for Helen, okay, from an insurance company perspective, is that I'll pay her $96,000, 75% of the time, and I'll pay her $0 in the case that she's healthy, 25% of the time. So her expected payout was 72,000, and that's also known as a fair premium. And even I'm trying to think, an insurance company charging a fair premium would again be making losses, in my opinion, because if you're charging a fair premium, you're only covering the medical expenses. You still want to cover your administrative expenses, overhead costs, maybe marketing costs, and other type of costs, taxes, and then you want to make some profits. Okay, sustainable would be if you're making. Let me think about that. Okay, so sustainable would mean, okay, basically a profitable business. To give you a short answer, sustainable. But basically, what does it mean to be profitable? That revenues have to be greater than costs. Okay, so I don't want to go too in depth because I think she's not testing you on that too much. She's just trying to get you to see that although the insurance company tried to pool the risk, that did not work because of the fact that Laura dropped out. If we could have gotten Laura to stay in, maybe it would have been a different outcome. Okay, I can answer your question, but it's about 6:50. Let me see if anyone else has a question. Patricia, Yvonne, any questions? If not, just say no. At least I know, I guess I gave you the chance to make any comments. Are both of you? Okay, yeah, that's fine too. Are both of you in Dr. Dumas's class or in the online class? Because I heard the online class was but was having a test tomorrow. So actually I'm going over, yeah, I figured. I'm going over a worksheet by Dr. Dumas, and what I'm trying to do is get some examples across, so I think that's good, rather than just talking about theory. But if you want this worksheet, especially if you came in late, just email me, because I don't like to, I don't know your emails and stuff, but and if you feel you may not need it, then I may not send it. So if you email me, then I could then do that. Okay, let me see. Yeah, so just email me, and then but it has to be soon, right after the session, so I could then send you what I also received. So Nicola also send me the answer key, so I could also send it to them, so they know that the answers are right or wrong, And by the way, I would first try and understand the basics. Like, don't overcomplicate the problems, because the problems can become more complicated if you start thinking about, different types of scenarios. So I wouldn't do that. First, I would try and understand the problems, because they're already a bit complicated if you're not, if you don't have an econ background. And once you really understand them well, then we could tweak them. Yeah, I know. But how about you, Patricia? And Yvonne, any questions from the online class? If you just want to follow along, that's fine too. Okay. And if you're new to the e-tutoring, then just I just want to say that the way it works is mainly I just try and answer students' questions. So what students do sometimes is they have questions prepared for me typed, and then that's good, because then we can use the time efficiently, and I could answer and give some examples, and we could discuss and things like that. But it also is beneficial if you guys are able to speak using a microphone. But if not, then that also works. But if you're more interactive, then I think you get more out of it, rather than me just solving the whole problem on my own. But let's see. We were left with whether the business was sustainable. And we said that a business is sustainable as long as revenues is greater than cost. So basically what I'm saying is we want profits to be, I want to say profits to be positive. That's really what we want. And then you asked a really good question of what, yeah, just positive. There's more theory involved. I would have to get into the average fixed cost, average variable cost, and stuff like that. But yes, anything positive for now. And even at zero, economic profit of zero, you know, because there's a difference between financial profit and economic profit. But again, I'm trying to avoid that issue because I know you're having a test. So, you know, just let's keep it simple. Exactly, as long as the final answer is not negative. The tricky part here is that some students may have thought that Laura could have stayed in the market. And then that's where you would get the whole problem incorrect. Because if we had charged Laura $48,000 and she would have stayed in the market, and her expected payout, I think, was $24,000. That was the fair premium, the expected payout for Laura. So we could have gotten some profit from Laura. If we had just gotten her to stay in the market, we would have got a revenue from her of $24,000. And then maybe that would have made up for Helen's loss. You see? Because as I guess, let's say you guys are going to be working in management, it's not enough for you guys to say, I think, for anyone to say as a manager, well, we'll have, if I raise prices, some consumers will leave and others will stay. We don't want to just know that basic conclusion. We also want to be able to explain how many customers would leave, why would they leave, and this is getting into the idea of that, if that makes any sense. So here we may have thought that we could have at least broken even like before by charging the fair premiums, more or less, but yet we see that that was not possible because Laura ends up dropping, so we're not able to counterbalance for Helen's loss. Well, so I'm saying, assume that Laura had stayed in the market, then they make a revenue of Laura of 24 and a loss of Helen of 24, and then in that case they make zero revenue, which is equivalent to having charged both the fair premium. Does anyone know what the fair premium for Laura was? 24, right? And what was the fair premium for Helen? 72. Okay, so I'm saying that this outcome would have been the same as this one, except you pass on more of the cost burden to Laura and away from Helen, because as a business, this is giving me zero revenue. Okay, that's not profit. I cannot say what profit is because they're not telling me what the administrative costs are. They're not telling me what the tax percentage is. And stuff like that. So that's why I'm not able to say how much profit they're making. But what I'm saying is that the revenue in outcome A, assuming that Laura had stayed, was zero. Assuming Laura drops out, the revenue is negative. So definitely we're not making any money there because we're not even bringing enough revenue, much less covering our costs. In the first scenario, we were charging both the fair premium, and then the revenue under that scenario was what? If I charge all my customers a fair premium, what would be my revenue? I'll let each of you answer and I'll drop there. I think if you can answer this, I think you're following me. So Lilian, Nicola, Patricia, Yvonne, can you try and answer that? If I charge each of my customers the fair premium insurance, which I said that no profitable business would do, because if in that scenario I wouldn't be even covering my administrative costs, my taxes, or making profit, what would be my revenue in that regard? Okay, it would be 96,000, it seems. Okay. However, what's my expected payout? Again, 96,000, right? Because that's my fair premiums. So that's why I'm saying those scenarios seem to be the same. It's just the loading fee passed on the burden to Laura. So here the revenue is 0. So, you know, that's possibly a problem. But even then here, if Laura had stayed, if the business is making 0, then it might stay in business. Okay. In here, it's also 0. That gets into economic profit, because economic profit accounts for the opportunity cost. So basically, if economic profit is 0, then it just means that accounting for their opportunity cost, they're okay. Meaning they can do no better if they engage in another type of business. Here I'm just explaining that the two scenarios are fairly similar. And here I guess you could call that maybe profit if we ignore administrative costs and stuff like that. But you could see that basically I get 96,000. I'm expected to pay out 96,000. So I think profit in both scenarios will be negative once I take into account that I have to pay my rent, my office rent, my secretary, and so forth. Okay, for the telephone line. So once I take into account my expenses, I have 0 revenue. But then this example, that's what. So I made it more in depth, so I think you could get more out of the problem. But then this example was more straightforward, although tricky. We just had to recognize that Laura would drop. The loading fee for Helen is a loss, and if I'm selling at a loss, I'm definitely not a sustainable business. Okay. Any questions or comments? All right. So then I hope that helped. All right. Yep, no problem. Thank you for joining, and I have to start another session, so I'll see you. Any last minute comments? All right, good luck in your exam.